What is going on, everybody? It's Struzyna with the Gunderman Group coming back to you with another video today. Like we've been talking about for the last couple of videos, we're talking about contingencies, mostly because I've been seeing this conversation pop up on Reddit, in the comments section in YouTube and on Instagram, all over the place, and it's really important to understand, especially if you're gonna jump into this really hot market. Specifically, I want to talk about the financing, or otherwise called the loan contingency, because it is really critical. It's a very important piece, especially with some of the volatility in the mortgage world that we're experiencing right now. And let's go ahead and first of all define what a contingency is. Like I've described on other videos about the appraisal and the inspection contingency, I'll link to those up here. A contingency, simply speaking, is your escape valve out of the contract. Gives you a legitimate way to get out and get your deposit back if something happens or something doesn't happen. So it's simply your way out, right? All right, so the loan contingency is basically encompassing your ability to get financing. So what that means is if you, for whatever reason, can't get a loan, something comes up on your credit, something changes in the rates and you can no longer afford it, or whatever the case is, you have a legitimate escape clause to get out of that contract and get your money back, right? However, as you can tell, sellers typically don't like that because their entire sale, their entire moving process is basically contingent on you being able to secure a loan. And that's not a place that a seller really wants to be, especially a seller who's in a really strong seller's market. And so what they're looking for is someone to be totally non-contingent, or as close to that as humanly possible. Now, when you go to write your offer, this is a very important question you have to talk to your lender about before you finalize that offer, decide whether or not to remove a contingency. The question you want to ask your lender is simply, would it be responsible for me to remove my loan contingency, given where I'm at in the underwriting process? Now, pro tip, I've done a ton of videos on this, I'll link to some of them up here, but simply you need to make sure you're working with a lender who will underwrite you ahead of time. There are pre-approvals, there are pre-qualifications, those are not good enough to be able to confidently remove a loan contingency. Until you're fully underwritten, underscore, highlight, bold, underwritten, make sure that you're holding on to that loan contingency, because there's enough volatility out there right now that you don't know what's going to happen. And there's too much out of your control, and it could really hurt your ability to secure financing. And if you don't have a legitimate escape clause, your deposit is at risk. All right. So this is a conversation between you and your lender to make sure you're able to confidently remove this if you're going to go that route at all. Now, that does require you to do a lot of diligence up front. Every time I meet with a buyer, the first piece of homework I always give them is talk to whatever lender they're working with, or I'll refer one of mine that I have a good relationship with and say, listen, go talk to these guys, give them a call, tell them about your situation, send them whatever documentation you need, and make sure that they're aware that you're looking to get fully underwritten so that you can be very competitive in this marketplace. And you can confidently know what your budget is. Because if you write an offer without a loan contingency, but just because you're trying to be competitive, but then the loan evaporates or the rates go up so high that it no longer becomes affordable to you, your deposit's at risk. So make sure you do this diligence up front. Just like the other contingencies, the loan requires you to do a lot of work ahead of time to know exactly what it is that you can afford and where that line is, where it's like not affordable, where it's not safe anymore, where the lending world is, and how you fit into it is really, really critical. So do that up front and know, like, supremely confidently that you are going to get that loan before you make that offer. If you find the house that you are interested in and you haven't gotten fully underwritten, that doesn't mean you can't write an offer. That just means you're going to have to write an offer with a loan contingency, and hopefully you can shorten it a little bit to be a little more attractive so there's less uncertainty in the whole thing. But ultimately, the only way you're going to do it is if you get fully underwritten. And you may not win that bid, especially in this market where all the buyers are getting pre-underwritten before they go and make that offer. However, make sure you're protecting yourself above all, because the deposit, the legal jeopardy, it's just not worth it just to try and be a little bit more competitive, trust me. Hopefully you got some value out of that, and if you did, hit that like button, subscribe to the channel, because I'm gonna continue to put out content just like this, and you're not gonna wanna miss it. So without any further ado, this is Hans Struzyna with the Gunderman Group at Keller Williams Luxury International signing off for now. See you guys on the next one.